Welcome to the From Lab to Patient, Garage to Market podcast with your host, Phil Crowley. In each episode, we will discuss professionals serving the tech startup market and the various issues of importance to those companies. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, CrowleyLawLLC.com. Now here's the host of From Lab to Patient, Garage to Market, Phil Crowley.
Hello and welcome. Thanks for tuning into our podcast. You know, we look to bring you leaders in the life sciences and technology who can share their perspectives on developments in those areas, how to succeed, mistakes to avoid, issues to be aware of, to try to demystify the process for you of taking great ideas from the laboratory into commercialization and hopefully to use that technology to enrich the lives of thousands or even millions of people. Today, I'm happy to have as my guest Aaron Price, who is the CEO of TechUnited, New Jersey. It's an organization and actually a community that's dedicated to supporting and publicizing the work of innovators in the Garden State. Aaron and his team have had a major role in enriching the early stage technology market in New Jersey. And I'd ask you to stay tuned. At the end of our discussion, I'll ask Aaron to give us one or two nuggets that you can use to help you avoid missteps in your own technology development and perhaps even increase your prospects for success. Aaron, welcome.
Phil, thanks so much for having me. It's great to be here.
Please tell us a little bit about your background, the pathway that led you to your current position leading this supportive group.
Sure. So I've been I've been an entrepreneur my entire life. My brother and I patented something in high school, and my first real tech company in 1998. It was called Deliver You. It was an online food ordering for restaurants at a time when the world looked a lot different. We didn't have, there was no iPhone. There was a lot of faxing still going on. So it was a very, very, very early time for an idea that now seems so obvious. I had a few other, that we did end up having a nice exit on that one and one other, but I had a few others that went nowhere. I found it to be a fairly isolating career path. It was, especially then, it wasn't it wasn't as interesting and popular in pop culture to be a tech entrepreneur. And so I was sort of on my own. My friends were doing more normal things like you in law and medical things and other professions. Mm-hmm. And so I got a little bit involved in the New York tech community. For the first time, felt like I was kind of with people who understood some of the same struggles. Started something called the New Jersey Tech Meetup that exploded, became the largest tech group in the state with like 9,000 members, and inspired something called the Propelify Innovation Festival, mm-hmm. Which is a large tech event on the waterfront, New Jersey, as I know you are aware, with all things tech and entrepreneurship. And that got acquired by what is now TechUnited New Jersey, the group you talked about earlier, where we are built to empower entrepreneurship and innovation around the region.
Well, what types of programs does TechUnited conduct for entrepreneurs?
So our members range from very early stage entrepreneurs, solo entrepreneurs with just an idea, to mid-market companies, to very large enterprise organizations like Verizon. So it depends on, our programs vary depending on the, sort of the group and the goal around the table. For early stage entrepreneurs, it's very personal. I was the member that I am now serving. I was the person who needed a lot of access to mm-hmm. expertise and wisdom, much like what I think you're trying to do with this show, to help people avoid mistakes. I made many of those mistakes a few times over, I think. And so we have events where we have networking, demos, and a speaker. The speakers vary, but we've had folks. Last night we hosted someone who's raised $10 million. Who's generated $10 million of annual revenue without raising outside capital. So that whole discussion mm-hmm. was around how you can pursue building a business without raising outside money. We also bring in venture capitalists to talk about what they look for in a pitch for people who are looking to raise capital. And a series of talks from experts to help you build your business faster and smarter, specifically with the idea of helping you save time and money. We advocate for policy issues that we think are very important. And we can get into this if you'd like, but we were the voice very strongly behind the scene, pushing for New Jersey to recognize qualified small business stock treatment, which is also referred to as QSBS. New Jersey was, until this summer, one of the 5 outlier states on that very important issue. Mm-hmm. We travel with the governor's team occasionally on trade missions around the world to talk about the mission and the opportunity, our mission and the broader opportunity in New Jersey. And we look to connect folks with talent, capital, and the opportunity to grow their businesses. And we also, I could go on forever, Phil, but we have a mentorship program for early stage entrepreneurs that connects them with big corporates. Mm-hmm. The mission is really to make it so that if you get involved with this group, we can accelerate your business and that, or your broader mission. So if you're an early stage business, we want to get you in front of capital, talent, and customers. If you're a large entity, just going back to like the Verizon or PSEG, the local utilities, an even better example, not necessarily seen as an innovator, but in fact is very interested in investing in innovation broadly. And so we put them in front of people and opportunities that we think also position them more broadly as an innovator in the region.
Let me pick up on an issue that you raised first, because I know this is going to be really interesting for our audience. And how did it occur that a company could build itself to $10 million in revenue without any outside investment at all? I think that is a magic trick that many of our listeners and viewers would like to replicate.
It is a bit of a magic trick. And I think that raising capital is a misnomer for selling part of your business. First of all, that's often, if it's an equity raise, that's what someone is doing. They're not just selling part of the business, they're selling part of the control of the business. And so I think entrepreneurs need to take very seriously that transaction. In many cases, it's worthwhile and necessary, and it can be a good thing towards an exit. But I think it is less talked about the downside that may come along with that transaction. So the person we're talking about was Noah from Stacker. He and his 3 other co-founders basically scraped together $15,000 each, put it into a bank account, and said we have 6 months to get to a place where we can pay ourselves at least a decent salary. Mm-hmm. And focused on, in their case, building a media company to do so. And it's 8 years later, so this was no small feat. They did get to a place where they have 40 employees, 10 million in revenue, and they own the whole thing. In short, he talked about focusing on revenue generation over product. So I should point out that a lot of our focus is around software in the tech industry. So when we talk about tech here, we're often talking about software, and now especially AI. I should point out that for your life science listeners, it's nearly impossible often to build a business.
Well, that's right, because the technology businesses, particularly SaaS-based software as a service, are so eminently scalable. I'll just volunteer that at this point this is September of 2025 that we're speaking about this. One of my oldest clients, which was a SaaS-based artificial intelligence company, recently sold itself to an international data products aggregator for about $500 million. And they had significant outside investment to get there, but the founders still had a significant stake. And when you get up to the roughly $500 million level for the totality of the company, everybody who has an equity stake comes out smiling. But go ahead.
But that's, I think people understanding the mechanics of what goes on behind the scenes in those fundraisers is important. So, we talked about how the average fund, it's been a little while since I've looked up this stat, but at one point in recent years, the average venture fund size was $150 million. Well, typically out of that fund, they're making 10 investments with some follow-on capital. They reserve some capital for investments in those same businesses later. Mm-hmm. they need their return to what is often referred to as return the fund. One company needs to pay back that 150, and then they make money on the others, and hopefully one does better. But I think some entrepreneurs don't understand the mechanics, the financial levers that are required for venture funds, the business of venture funds to make money. And so, inexperienced founders in the tech world, say, "Oh, I heard that you turned down an offer for $50 million. That's crazy." Well, that is a deal that a venture firm, if they invested in, probably needed to say no to, because it probably didn't work for the returns that they need for their own, investors, their limited partners. And so I just think it's really important, like to your point, depending on how much they raise and when they raise it, probably everyone did well in that $500 million deal. But there are times, maybe it doesn't sound like it in this case, but there are times when maybe they raised a year ago and a $600 million valuation, and this was a fire sale. Like sometimes the headline isn't what happens in the bank accounts. And I just think it's really, really important for entrepreneurs to understand what they're signing up for and what these deals really mean for themselves personally.
Interesting. Well, you mentioned the work that you personally, I know, and TechUnited had done to change some legislative provisions in New Jersey that were kind of atypical. Can you go into a little bit more detail about that? Because I don't think that all of our audience really understands the implications of being qualified as, quote, qualified small business stock, unquote, under the Federal Internal Revenue Code. Can you go a little bit into the details of that?
I can, and it's a little dense. I'll try to make it entertaining, but I think it's important. Even if this is boring, many of your listeners probably need to know this issue. In order to incentivize investment at the earliest stages in business, the riskiest part of building a new business, the government on the federal level has a variety of incentives. One of them is we'll just use you, Phil, as the example here. Should Phil invest in my new business at the earliest stage? We as a country, at least for now, have decided we want to incentivize that behavior. And so to do so, we say, okay, well, if I ever have an exit or another term for selling the business, Phil's first, it just recently changed to $15 million of a gain, is tax-free from his capital gains on the federal level. So that's a significant tax savings, and it increases the return on his investment should we do well. In theory, people, again, just using you, Phil, as this example, if you're investing in my business, you probably invest in a few others. So that sort of incentive helps de-risk it, because I just talked about, right, the venture funds, they look for 1 in their 10 to do well. That's kind of the math, roughly. Right. And so you need them to do well to make up for all the losses. And so that's one of the federal incentives.
And so that's $15 million for every individual company that you invest in. It's not just $15 million for you as a person.
That's a good, that's a good distinction you're bringing up. It's $15 million. If Phil, I should have picked some other person since I'm talking to you, but if the investor invest in 10 companies, each one potentially has that, qualifies for that benefit. Mm-hmm. And so if you live in New Jersey, you also pay state capital gains taxes. And so New Jersey was one of 5 states that until this past summer did not allow for that same treatment of your capital gain at the state level. Mm-hmm. And so, for those of your listeners who aren't in this local region, we're an interesting geography in that we're in between Philadelphia and New York. And so there's a lot of competition for talent and dollars. And New Jersey has a lot of great things going on, but we are often in the shadow, especially of New York, where there's a fantastic and robust and mature tech community.
Right.
And so we want to keep our dollars here. And when there are these exits, when there are these sales of businesses and people get hit with that extra tax bill, we've seen a lot of them move or complain or not want to continue to invest in the state.
Right.
And so we were successful in lobbying to change this law. And as of any gain that is that you earn post Jan 1, 26, if it qualifies federally, it will qualify in New Jersey. And so we're very, very pleased with this change in legislation.
And Aaron, I know you have another legislative victory to share, but before we do that, I just wanted to take a minute to introduce our viewers to Crowley Law. We are a boutique law firm of 4 very experienced lawyers who are passionate about helping life sciences and other technology innovators avoid being taken advantage of as they pursue their dreams. As a former research physicist, I did my work in superconductivity. I have a great understanding and experience in spending long hours in the lab trying to develop new knowledge. I know how difficult that is. And as a corporate lawyer, I understand how difficult it is to take ideas, even really great ideas, and turn them into products and services that can be commercialized and hopefully enrich the lives of thousands or even millions of people. So we have a website, crowleylawllc.com, with a lot of frequently asked questions, free resources, and copies of these podcasts, as well as further information that may be of use to innovators. In addition, I recently published my book, Avoid Startup Failure. Learn the top 10 causes of failure for technology startups and how to turn them to your advantage. So I recommend that to you. You can get it out on Amazon if you Google Avoid Startup Failure or Google my name, Philip P. Crowley. And I just wanted to remind you that we're here to help you when you have a need, and come out and take a look at our resources. We're here to help. Now, Aaron, I want to get back to the wonderful work that you have done over a substantial period of time in enriching the environment for innovation at the legislative level. So you had one win this time around, but there's another win that I'm aware of that I'd like you to explain to our audience.
Sure. So the previous win, QSBS, very psyched about that. The other policy that I believe you're referring to is the angel investor tax credit. Same theory, same principle. We as a state want to encourage early stage investment. We want to make sure that businesses are born and grow here. And so to help make that happen, the state has a credit that says, we'll use a different example this time. If Susie wants to invest in my new business, and she puts in, just to make round easy math, she puts in $100,000 in my new startup. Until recently, she would get back from the state 20% of that investment as an actual tax credit. Or if you don't live in New Jersey, the state will actually send you a check.
Actual money from the state of New Jersey?
From the state will actually show up as a check.
That's a new one, Aaron.
Yeah, I imagine that. And if you are a women or minority business owner, there's actually a 5% additional incentive, so up to 25%, up to $25,000 in that example with Susie.
Well, that sounds like a good deal.
It's a pretty good deal. It sounds great. However, it turns out, if you look around the country, there are lots of these programs, and the average of the incentive that I just described as 20% or 25% for minorities is actually 34.9%. And in Maine, it's as high as 60%, which is incredible. So we were also lobbying to really see that percentage increased. Again, there's some nuances here. I don't know if it gets a little boring, but the way the law is written is that the state will do that, will administer that program up to a total issuance of checks that sum $35 million. So it's not an unending pool of capital. They cap the amount. Well, we've only really been tapping into, depending on the year, $8 and $15 million a year. So we were not getting even close to expending the full budget of this program. And so we've been making the argument that it's not really that strong of an incentive. In fact, the metaphor we would use is if it's like you're walking down Main Street and there's 25 different stores and you have your 20% off coupon, that sounds great until you realize everybody else is a 35% off coupon.
Yes.
It's just not that competitive.
Well, even the states are in a competitive environment trying to vie for innovators, like hopefully the people who are watching this podcast. So you are a commodity in demand.
The states are very interested. This country is very interested in economic development, and that happens at the local level. And so, that happens in every backyard around this country, no matter where you are. And so the states are often very interested in that economic development, that creation of jobs, that tax base. There's a lot of things that go into the many obvious reasons why you'd want to see businesses grow in every backyard in the country. And so to make that happen, they have these programs. So we were successful at the same time as passing that QSBS bill in increasing that incentive to 35%. So we're at least now on par with the country. And there is still the additional 5% for minority business owners. So it's up to 40% if you invest in a minority or a woman. So I was hoping we were going to get that to closer to 50. I wanted a headline that would make major national news. I think 35 is healthy. We'll see how we do. New Jersey is underfunded. We don't have as much activity as I would like to see in that angel category. And if you don't have, it's a funnel. If you don't have it there, it's harder to have it when you need venture dollars. So that was a big win. Very, very proud of that, but we're not done yet.
Yeah, well, that's two feathers in the cap for you and for TechUnited. So hats off to both of you. But what about your assessment of the current economic environment? We're in an environment which is unsettled. Interest rates are, according to some people, higher than they ought to be. How is that affecting the innovators in your community?
This is something I think a lot about, maybe more personally than as on behalf of the organization, although they certainly are very close. I think we're at a tough time in the economic cycle of history, because part of what we do in tech, or part of the businesses in tech, especially with AI, allow for people to make enormous amounts of money with fewer and fewer employees. And so it used to be that you'd look at a GE, a General Electric, and say, well, there's 200,000 employees, and you'd count average revenue per employee, and it was a bellwether for the health of an industry and of a market. And now if you look at some companies that are doing 60, 100, $200 million in revenue, and they might have 10 or 20 or 30 or 50 or 100 employees, the revenue per employee metric I just talked about with GE, like, it's a wildly different number today. There are companies that are not raising money, raising very little, and selling for $50 to $100 million. And I think that this more broadly is creating a deeper disparity of wealth. So I would say the real, it's a long preamble to your question, which is, I think tech is a little shielded from it, not entirely, because often we are the group that are building the companies that are taking advantage of the economic conditions, which I have no problem with. But I think as a society, we need to think about a way that we can elevate, people who are working hard and trying to advance themselves and their family have opportunity to do so, and that the opportunity to start a business or get involved in a business that grows, to create individual wealth, be part of a team that grows, to build something is more accessible and somehow either, that we bring more people along for that ride.
Mm-hmm. Well, you're doing that in the technology-based community. Is there something else you'd like the government at the federal or state level to help people consider entrepreneurship, as opposed to always thinking of being an employee, even though, as we both know, the road to entrepreneurship is a difficult one, and it's littered with many failures before you get to be successful?
I think this is primarily not everyone is built to be a founder. I do think, lots of people are built to work hard and do great things. It does, being a founder and starting something does come with enormous risk. My hope is that we provide people with TechUnited, is that we give people the resources to de-risk these things a little. And we're not going to take it from, an 80% chance of failure to a 20% chance of failure, but we might shave a few points. We might shave 10%. We might save you 6 months because you didn't spin your wheels on an issue that that you were doing wrong, and that's meaningful. That's dollars in your pocket of what it would have cost in your what's referred to as a run rate, or actually in that case your burn rate. And so, is there something the government should do? I think these types of programs to encourage investment help a lot. It's important to me that no matter who you are and what your background is, you have you're at the start, you get the same starting line as everybody else. That's what I hope that we can do at TechUnited. You're still going to have a very difficult uphill battle no matter what. None of these things are easy. But I do hope that we create an environment that makes it a little bit more accessible and that saves you a little bit of time and money via knowledge and connections in the process.
Well, if you had a magic wand and somebody or a group of people dropped another $1 million or $2 million in the coffers of TechUnited, what sorts of programs and innovations would you like to see TechUnited be able to deliver to its community?
That's a great question. There's two things that come to mind. One is I'd like us to launch a world-class AI accelerator and incubator. So for those who might know Y Combinator and Techstars and things like that, I think we are in a position to launch a world-class. The New Jersey thing, by the way, as a quick side note, I'll come back to your question. I like to do great things with great people that happen in my backyard. It happens to be I'm in New Jersey. I'm not a hardcore, I'm proud of New Jersey. I like a lot of New Jersey things, but I'm not doing this because of New Jersey. I'm doing this because I want to do great things with great people, and it happens to happen here. And,
right.
And I think that's an important thing for other people to think about. Like, you don't have to be gung-ho your area, but if you set a high bar of excellence, you do it with great, you do things, you build things with great people, amazing things can unfold. In my case, I ended up in a position I never would have imagined I would have ended up in. Getting back to your question of what would we do if a bunch of money dropped in our lap, one is I think we are surrounded by resources that we could launch a world-class incubator. And two, we need a lot more, frankly, young Aaron Prices in market. And what I mean by that is I talked in my bio about I started the New Jersey Tech Meetup. It was a grassroots. It was not even a business for a long time. It now officially is a nonprofit, but it was just a group that met to network and share, with one another. Very authentic in that pursuit. No entity behind it.
Right.
I wish we had hundreds of. They don't have to be young people, but they tend to be young people leading small groups in every backyard around the state, where they're gathering people to get together and share what you're working on and help one another out. That's a hard thing to do. Usually you ask somebody has to buy the pizza and rent a room, and it takes a bunch of hours each month. Like it is very much a labor of passion. We eventually made a little bit of money on it, but like 5 years later, you don't do that kind of thing for the money. So if we had a bunch of extra money, I would love to subsidize or create scholarships to find another 10 or 20 or 30 or 50 ambassadors who could run programs like that all around the state. That's what.
That's great. Those are some great ideas. Well, the governor certainly has taken maybe a part of a page out of your book in establishing a number of accelerators in New Jersey and throughout New Jersey in order to provide platforms for growth of technology companies. But, you seem very passionate about what you're doing, Aaron. What do you like most about what you do?
What do I like most about it? The thing I like most is when I meet people who say, when I find out it's working, when I talk to people who say, I've gotten so much out of this community. I've met people who've helped me. I've hired someone. I started a business. We have several people who had a day job who decided to leave it and start something. Not always successful, I should say, but some of them have become very successful. That's enormously gratifying. Last night, I know you've been to a lot of our AI demo nights and those sorts of events. Last night, we've had someone who goes to high school in Irvington to someone who's approaching retirement. And I that's not great for selling sponsorships because sponsors want like a specific demo in a room. But if you're a lawyer, you want 10 founders who can hire you. But as an organizer of these things, I love that it's accessible and that high school kid who had no idea what this was all about is learning just as much as the guy who's maybe thinking about a third career because he's maybe at the end of his own career, but thinking about other things he might want to do, and AI makes that easier. And so that for me is enormously gratifying.
That's fantastic. All right, Aaron, what one or two nuggets can we leave the audience with that they should be thinking about, focusing on to help them on their journeys of entrepreneurship?
I was thinking about the best couple of nuggets. The two that stand out to me are intense discipline, especially when it comes to time management. It's very easy for let's just jump on a call to be a 30-minute thing when it could have been a 5-minute thing. It's very easy for this product will ship next week, but actually it's 3 weeks later. And I have done this in my own life. I'm sharing this very firsthand experience where I set a goal. Okay, if I'm not here in 3 months, I'm going to quit. And then I have justified to myself why, well, I didn't hit that metric, but maybe not, I'm going to quit. I'm going to try something else. If I didn't hit that metric, I sort of, well, this didn't go that way and this can go that way. But the truth is, those metrics were telling a story that I didn't listen to. And especially when I was in my 20s, time felt unending. And so I probably spent an extra year or two on things that I should have spent only a couple, I should have, months into it, I should have realized I'm not solving a pain point that the market wants. So I think really strong discipline on time management. And it's not measured in weeks and months. It's measured in minutes and hours. Don't take meetings you don't need. Be obsessed with focus on the things that matter. It's one of the reasons that I think it's not so terrible to not take a salary for a little while, because it forces you to focus on the thing that matters the most, which is revenue. So that's number one. It's a little more than the size of a nugget, but hopefully it does the job. The second one would be surround yourself with great people. Hire slow, fire fast. I would say another mistake that I've made. I took too long to fire people where I knew it wasn't working out. So that stands out. I also saw myself for way too long as my mission now is to create things that are reproducible, where if I leave, they live on without me. And I think that probably ego when I was younger drove me to want to do it much more myself. And the goal is to get yourself out of the way. Surround yourself with people who are better than you. Don't be the smartest person in the room. Elevate the entire organization by finding real expertise, and then creating processes that allow those things to excel with or without you. So those are the things I would focus on.
All right, Aaron, thanks so much for sharing your perspectives with your great experience in the innovation space. This is very valuable. If people want to get more information about you and the work of TechUnited, where can they find that?
They can find that at techunited.co.
Super, techunited.co. Well, I hope our viewers have enjoyed this discussion. If you have, please visit our website, crowleylawllc.com, for library of free resources. Remember about the book, Avoid Startup Failure. It provides a focus on the top 10 causes of failure for technology startups and how to turn them to your advantage. We are in the corner of founders. And just remember, we're here to help. We hope you've enjoyed the discussion. Please subscribe to our podcast so you won't miss the next one. And thanks again for joining us today.
You've been tuning into the From Lab to Patient, Garage to Market podcast with your host, Phil Crowley. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, crowleylawllc.com. If you found this information helpful, please subscribe, leave a positive review, and share with others.